In 2001, one company was worth more than $60 billion. It was praised by Wall Street, admired by politicians, trusted by millions of investors. For 6 straight years, Fortune magazine named it America's most innovative company. Its executives were treated like celebrities. Business schools studied its success. Analysts called it the future of corporate America. Its name was Enron. On the surface, Enron looked unstoppable. Its stock had climbed from less than $10 a share to more than $90 by August 2000. Investors believed they were buying into one of the greatest companies ever built. But behind the polished annual reports, behind the confident earnings calls, and behind the billions of dollars in reported profits, a different story was unfolding. One built on increasingly risky boardroom decisions that few people outside the company truly understood. Inside Enron's headquarters, executives weren't just trying to build a business. They were trying to convince the world that Enron could grow forever. Quarter after quarter, year after year, the company promised bigger profits, higher revenues, even greater opportunities. Wall Street expected Enron to keep delivering. Missing those expectations was becoming unthinkable. So instead of slowing down, instead of admitting certain projects weren't working, the company began making decisions to make financial statements look stronger. At first, almost nobody noticed. The numbers looked impressive. The stock kept rising. The praise kept coming. But every new decision made the company more fragile than the one before. Until one day, the illusion became impossible to hide. This is the story of how one of America's most admired companies became one of the biggest corporate frauds in history. Every great collapse begins with a great success. Enron wasn't born as a fraud. It began as a legitimate energy company. In 1985, 2 natural gas pipeline companies, Houston Natural Gas and InterNorth, merged to create a new corporation. Its chairman was Kenneth Lay. Lay wasn't a loud executive. He was calm, well-connected, and highly respected in Washington. And he believed the future of energy was about to change forever. For decades, energy companies followed a simple business model. They produced natural gas and transported it through pipelines. And they sold it at government-regulated prices. It was predictable, stable, but it wasn't exciting. Then, during the 1980s and early 1990s, the U.S. government gradually deregulated parts of the natural gas and electricity markets. Instead of fixed prices, energy could increasingly be bought and sold in competitive markets. Kenneth Lay saw an opportunity. What if Enron didn't just transport energy? What if it became the marketplace itself? Instead of making money from pipelines alone, Enron could make money connecting buyers and sellers. It was a bold strategy, and for a time, it worked brilliantly. Enron expanded beyond natural gas. It entered electricity trading, broadband, water projects, and international energy markets. The company wasn't just growing, it was reinventing itself. By the late 1990s, Enron had transformed from a traditional pipeline business into one of the world's largest energy traders. Wall Street loved the transformation. Investors believed Enron had discovered the future. But inside the boardroom, success created a dangerous new expectation. The company no longer had to grow every single quarter. And soon, one executive would arrive with a financial strategy that seemed to make that possible. In 1990, Kenneth Lay hired a consultant from McKinsey & Company. His name was Jeffrey Skilling. Skilling wasn't an ordinary executive. He was brilliant, confident, and fiercely competitive. He believed Enron shouldn't think like a pipeline company, should think like Wall Street. To Skilling, energy wasn't just something that flowed through pipelines. It was a financial product, something that could be bought, sold, traded, priced, just like stocks or bonds. It was a revolutionary idea, and initially, it worked. Enron launched one of the world's first large-scale energy trading operations. Instead of simply transporting natural gas, the company became a market maker, matching buyers and sellers while managing energy contracts. Profits surged. Wall Street rewarded Enron with even higher valuations. But rapid growth created a dangerous problem. Every quarter, investors expected even bigger profits. Missing expectations wasn't just disappointing anymore, it threatened the company's soaring stock price. Skilling believed traditional accounting couldn't keep up with a fast-moving business like Enron. Many of its contracts would generate cash over years, sometimes decades. Waiting years to report those profits made the company look slower than it believed it really was. So Enron sought and received approval from the US SEC to use mark-to-market accounting for certain long-term energy contracts. The idea sounded reasonable, instead of waiting years to recognize profits. Enron could estimate the total profit a long-term contract was expected to generate, then record the estimated value much earlier. The method itself wasn't illegal. Many financial institutions used forms of mark-to-market accounting. The real danger came later, because those estimated profits depended on assumptions about the future, and assumptions can always be made more optimistic. As pressure inside the boardroom continued to grow, those assumptions would become more aggressive, and eventually it would stop reflecting reality altogether. For a few years, Enron looked unstoppable. Stock kept climbing. Its executives kept making bold promises, and Wall Street kept believing them. But behind the scenes, a serious problem was growing. Many of Enron's investments weren't performing as expected. Some energy projects were losing money. Others were worth far less than the company had predicted. If those losses appeared on Enron's financial statements, investors would notice. The company's soaring stock price could begin to fall. Inside the boardroom was becoming unacceptable. Instead of asking one difficult question, should we slow down? The company asked a different one. How can we keep the bad news off our books? The answer came from Enron's chief financial officer, Andrew Fastow. Fastow proposed creating hundreds of separate legal entities known as special purpose entities, or SPEs. On paper, they were independent companies. In reality, many were closely connected to Enron. Some of these entities bought struggling assets from Enron. Others took on debt that Enron no longer wanted to show on its own balance sheet. The transactions made Enron's financial position appear much stronger than it really was. To investors, the debt seemed smaller. The balance sheet looked healthier. Quarterly earnings continued meeting expectations. But there was a fundamental weakness. Many of these structures depended on one thing: Enron's own stock price remaining high. As long as investors believed the story, the system could keep operating. But if confidence disappeared, everything supporting those structures could begin collapsing at once. And then, the board approved a decision that made the situation even more dangerous. Creating special purpose entities was only the beginning. The bigger question was, who would run them? Normally, a company's executives are expected to act in the best interests of their own shareholders. They are not supposed to personally profit from deals made with the company they manage. That rule exists to prevent conflicts of interest. But inside Enron, those safeguards began to disappear. Andrew Fastow wanted to manage several of the special purpose entities himself. That meant he would be negotiating deals on both sides of the same transaction. As Enron's chief financial officer, he represented Enron. As the manager of the partnerships, he represented the entities buying assets from Enron. The conflict was obvious. Company lawyers raised concerns and outside experts questioned the arrangement. Even Enron's own code of ethics prohibited executives from having financial interests that conflicted with the company. Yet in 1999, Enron's board of directors approved an exception. They voted to waive parts of the code of ethics for Andrew Fastow. It was one of the most controversial governance decisions in modern corporate history. The board believed the partnerships would benefit Enron. Fastow argued they would help manage financial risk. Instead, they made Enron's financial reporting far more complicated. Many investors had no idea how deeply these partnerships were connected to Enron. The company's financial statements became increasingly difficult to understand. Analysts continued recommending the stock. Credit rating agencies gave Enron strong ratings, and Wall Street kept believing the numbers. But inside the company, not everyone was convinced. A few employees had started asking uncomfortable questions. One of them would soon write a letter that became one of the most famous warnings in corporate history. By 2001, cracks were beginning to appear. Enron was still reporting billions of dollars in revenue. Its executives continued appearing on television. Wall Street analysts were still recommending the stock, but inside the company, some employees were becoming deeply concerned. One of them was Sharon Watkins. She wasn't a senior executive. She wasn't a board member. She was a vice president who had spent years inside Enron's finance department. The numbers no longer made sense. The partnerships had become incredibly complicated. Transactions moved assets from one entity to another, only to move them back again. On paper, everything looked profitable. In reality, many of the deals weren't creating real economic value. Watkins feared something far worse than poor accounting. She believed the company could collapse. On August 15, 2001, she wrote an anonymous letter to Kenneth Lay. The message was direct. She warned that Enron could implode in a wave of accounting scandals. It wasn't an accusation made years later. It wasn't written after the collapse. It was written while Enron was still one of America's largest companies. Kenneth Lay eventually met with Watkins to discuss her concerns. Outside lawyers were brought in to review some of the issues, but the investigation remained limited. The board wasn't told everything. The public wasn't told anything. Enron continued assuring investors that the business remained strong. Inside the boardroom, leaders still believed they could solve the problem, but outside the company, something even more dangerous had already begun. Journalists, analysts, and a handful of skeptical investors were starting to ask the same questions. And once those questions reached Wall Street, the entire illusion would begin to unravel. On October 16, 2001, the story changed overnight. Enron announced a third-quarter loss of $618 million. At the same time, the company revealed a $1.2 billion reduction in shareholder equity linked to transactions involving its special-purpose entities. For many investors, this was the first sign that something was seriously wrong. Wall Street immediately wanted answers. Why had one of America's most admired companies suddenly lost so much money? And why hadn't anyone seen it coming? The questions only became louder. Just 3 weeks later, on November 8, 2001, Enron admitted it had made significant accounting errors. The company announced it would restate its financial statements. Going back to 1997, years of reported profits had to be corrected. Billions of dollars in debt that investors hadn't clearly seen were now impossible to ignore. Confidence disappeared almost instantly. Banks became nervous. Trading partners demanded more financial guarantees. Credit rating agencies warned they were reviewing Enron's credit. Investors rushed to sell their shares. The stock that had traded above $90 the previous year collapsed into single digits within weeks. Inside headquarters, employees watched their retirement savings disappear. Many had invested heavily in Enron stock through the company's retirement plans. Some had spent decades building careers they believed would secure their future. Now, they were watching everything collapse in real time. The boardroom had spent years trying to protect Enron's reputation. Instead, its decisions had destroyed the very confidence the company depended on. But the final blow was still coming. Because once Enron lost the trust of the credit markets, there was almost no way back. By the end of November 2001, Enron was running out of time. The company needed cash, fast. Its credit rating was collapsing. Banks were pulling back. Investors had lost confidence. And every day, the situation became worse. Enron's leadership desperately searched for a way to survive. There was one final hope: a merger with its biggest competitor, Dynegy. On November 9, 2001, Dynegy agreed to acquire Enron in a deal valued at roughly $8 billion. For a brief moment, it looked like Enron might escape disaster. Employees felt a sense of relief. Investors hoped the crisis was over. But as Dynegy's executives examined Enron's finances more closely, they discovered problems far greater than expected. The company's financial position was deteriorating by the day. The risks kept growing, and confidence kept disappearing. On November 28th, Dynegy walked away from the deal. The rescue was over. That same day, all three major credit rating agencies downgraded Enron's debt to junk status. The consequences were immediate. Many of Enron's loans required the company to maintain investment-grade credit ratings. Once those ratings disappeared, billions of dollars became due almost immediately. Enron simply didn't have the money. 4 days later, on December 2, 2001, Enron filed for Chapter 11 bankruptcy protection. At the time, it was the largest corporate bankruptcy in American history. More than 20,000 employees were affected. Thousands lost their jobs. Many saw retirement savings built over decades disappear. Shareholders lost billions. One of America's most admired companies had collapsed in less than 2 months. But the bankruptcy wasn't the end of the story. It was only the beginning. Because investigators now wanted answers. How had this happened? Who was responsible? And could one company's collapse really destroy one of the world's largest accounting firms? The investigations that followed would permanently change corporate America. Enron was gone. But the investigation was only beginning. Within days of the bankruptcy, federal investigators, the U.S. Securities and Exchange Commission, and the Department of Justice began examining what had happened inside the company. They wanted to know one thing: how had one of America's largest corporations hidden so much debt for so long? The investigation quickly expanded beyond Enron itself. Attention turned to Arthur Andersen. For decades, Arthur Andersen had been one of the most respected accounting firms in the world. Its job was simple: review Enron's financial statements, challenge questionable accounting, and protect investors. Instead, it became part of the scandal. As investigators closed in, employees at Arthur Andersen began destroying thousands of Enron-related documents. Paper records were shredded, electronic files were deleted. The document destruction continued even after the SEC had begun investigating Enron. When the public learned what had happened, trust in Arthur Andersen collapsed almost overnight. The firm was convicted of obstruction of justice for destroying audit documents, although that conviction was later overturned. The damage had already been done. Clients left, employees resigned. One of the world's big 5 accounting firms effectively disappeared. Meanwhile, Enron's former executives faced their own legal battles. Andrew Fastow pleaded guilty to multiple criminal charges. Jeffrey Skilling, who had resigned as CEO, was charged with fraud and conspiracy. Kenneth Lay was also charged with multiple criminal offenses. The company that had once symbolized American innovation had become a symbol of corporate deception. But Enron's biggest impact wasn't the prison sentences. It was what happened next, because Washington decided the rules had to change. Enron didn't collapse because energy trading was a bad business. It didn't collapse because the economy suddenly changed. It didn't collapse because of one bad investment. It collapsed because of one boardroom philosophy: protect the stock price at any cost. Every major decision followed that same logic. When growth slowed, they changed the accounting. When debt increased, they moved it somewhere investors couldn't easily see. When conflicts of interest appeared, the board approved exceptions. When employees raised concerns, the warnings weren't fully acted upon. And when investors started asking questions, the truth was already too large to hide. None of these decisions destroyed Enron by themselves, but together, they created a company that looked incredibly successful, while becoming increasingly fragile underneath. The irony is impossible to ignore. Enron wanted to become the smartest company in America. Instead, it became one of the biggest corporate scandals in history. Its collapse changed financial reporting. It changed corporate governance. It permanently reshaped how public companies are audited. In July 2002, the United States passed the Sarbanes-Oxley Act. The law introduced stricter corporate governance requirements, strengthened internal control reporting, increased executive accountability, and imposed tougher penalties for financial fraud. Many of those reforms were a direct response to Enron and other major accounting scandals of the era. Today, Enron no longer exists. Its headquarters are gone. Its stock is worthless. Its name survives for one reason: not because of what the company built, but because of what its boardroom chose to protect. The greatest corporate disasters rarely begin with one catastrophic decision. They begin with small compromises, repeated over and over, until honesty becomes more dangerous than the lie. And in Enron's boardroom, that was the moment the company sealed its own fate. If you enjoyed this episode of Boardroom Files, subscribe for more true stories of the boardroom decisions that built and destroyed the world's biggest companies.